Alright, so for this week, there has been two major events that most Canadians are paying attention to. The first one is our own election, and the second one is the potential collapse of the Evergrande company in China. So what I want to do this week is make a financial news segment that we have done before, which a lot of you said you really like and you want to see it regularly. And in here, we'll be focusing on the real estate impact that both of these news could potentially have onto the Canadian market. So if that's something you're interested about, then keep watching this video. Now, without further ado, let's get started. So first one, let's talk about something that's happening within the country, and that's the election. Now, as we all know, Liberal Party have won their election once again as a minority government. The seating compared to the last election is more or less the exact same, plus and minus one seat here and there. Now for this video, I don't want to focus on the effectiveness or whether we should have an election or not, but instead I want to focus on the real estate policy or the housing policy that they said they would be implementing and how that might affect our real estate moving forward. Now we know that Liberal and actually all parties on the platform have talked about affordable housing. This is actually one of the biggest key that people are concerned about, and in their Liberal Party have said that they will commit money to build more affordable housing. However, what I want to do here is actually look at the other side on how they're affecting people's buying power, especially the first-time home buyers. Because I think while some of these policies are pretty interesting and could be helpful, in combination of all of them, I think it's actually gonna have the opposite effect, and we might see something like a crazy bidding cycle once again in some part of the market. So let's look at all these policies one by one together and discuss on why I think this have the opposite effect. Now, the first policy that they want to do is actually increase the CMHC cap from $1 million homes to 1.25 million. For those that don't know what this is, basically when you buy a home in Canada, you have to put down at least 20% down payment or else banks will not lend to you. However, if you want to go under 20%, you will have to go through a program called the CMHC insurance program. However, in exchange, you will have to pay for the CMHC insurance premium, and usually people put this premium on top of their mortgage and let it amortize over the next 25 to 30 years. Now, by increasing up to 1.25 mil, what that really means is that now you can have less than 20% and still get a much more expensive home. Now, for this policy alone, if this is ever confirmed to be implemented, I'll probably see a much slower sale for all homes up to the 1.25 mil range. Because if you think about it, for buyers, if I'm going to buy a home that's up to 1 mil, with this coming out, I might put on hold and wait until the policy is out, because now I might be able to get a 1.25 mil home and suddenly my option is a lot more than before. And as for seller, it's the same thing. If I know this policy is going to be implemented and my home is going to be hovering around 1 mil, I might put this on hold because after it's implemented, I might be able to sell it at a higher than 1 mil price. Now, if a 1 mil home is going to put on hold and potentially be able to sell at a higher price later on, so will the 900K home. Because later on, if your 1 mil is going to have a high demand after the policy and increase to 1.1 mil, then my 900K home is going to increase to 1 mil after, and so on and so forth. So this is why I think if this is going to be implemented, we might have a short-term volatility or maybe a complete stop to markets that's up to the 1.25 mil range, because now people are really gauging and waiting for the policy to be implemented to see what's going to happen with the purchase power and the selling options. Now next, the second policy that they think about implementing is also to cut CMHC rates for the insurance cost by 25%. On the platform website, they said that this will average save people a $6,000 in terms of insurance cost. However, if your home is closer to the 1 mil, as you can see on the screen, this is really more about a $9,000 cost saving. Now, even though $6,000 to $9,000 in CMHC cost saved is pretty nice, I don't see this to affect the market too much either way, because people put this cost on top of their mortgage and let it amortize over the next 25 to 30 years anyway. So $6,000 or $9,000 over 25 to 30 years, it really makes no difference. So while this sounds nice, I don't see this impact the real estate market in any way. However, the next one might do more of a job because they also want to increase the tax credit for first-time home buyer from $5,000 to $10,000. Now, as we have talked about before, tax credit actually works different from deductible. Tax credit directly takes off from your tax bill at the end. So by doubling the tax credit to $10K, this actually gives people $5,000 more back to their pocket by getting their first home. So indirectly, this increased their buying power from $5,000, and that could be used towards their furniture or renovations. Now next, they also want to implement a new first-time home buyer saving account for people that's under age 40. And I think this is probably one of the biggest news next to the CMHC cap increase. Because for this account, it basically works like a combination of all the strengths from RRSP plus TFSA without any of its weaknesses. For this account, first-time home buyers can put up to $40,000 into it, and like in RRSP, every dollar that you put into it, you can directly deduct from your income, so you can reduce your tax bill. And also, any growth that's happening inside is also going to be tax-free, so very similar to a TFSA. Plus, when you're ready to buy a home on withdrawal, you will not face any penalty, nor do you have to pay this back over time, unlike the existing RRSP home buyer plan where you will have to pay this back over the next 15 years. Now, they didn't really say on the website, but I would imagine this to completely replace the RRSP home buyer plan, so you cannot use both. You can only use one, but not the other. Or else that's just going to give way too much tax saving and buying power for first-time home buyer. However, it doesn't matter, even if you can only use this account, just this account alone is going to give a lot more buying power to the first-time home buyers. So let's say you're 30% tax bracket right now. If you put 40K over time into this account, it's going to give you roughly a $12,000 in tax saving. So your 40K now is going to automatically become $52,000 before you count any investment growth that's happening inside. Now, I would imagine you can combine this with another partner or couple and both have this account. Suddenly, your $80,000 of down payment now will automatically jump to over 100K just from tax saving alone. Now, finally, for this account, they said that if you are not using this for your first-time home buyer, then they will just roll over to a normal RRSP and keep growing that way. Now, on top of all these, don't forget that we also have the first-time home buyer incentive that's implemented in 2019. Basically, that's the Canadian government lending you part of your down payment for your first home, and you only have to pay it back upon selling your place and sharing a little bit of the profit with them proportionally. And here's why combining all these I really don't think is healthy, nor is it going to solve the problem. Because at the end of the day, they're just artificially inflating first-time home buyers' purchasing power. Now, they didn't say for the new CMHC cap increase what's the minimum down payment for the new 250K portion, but we know that it's 5% for the amount up to 500K, 10% for any amount that's over 500K up to 1 mil. Logically, we can assume it's probably going to be 15% for the amount that's over 1 mil up to 1.25 mil. So doing the math, if this rule is true, if you're going to buy a 1.25 mil as a first home, then your minimum down payment is $112,500. Which we have talked about before. If both people around 30% tax bracket fully utilizes the $40,000 room of the first-time home buyer saving account, plus tax saving, plus maybe a little bit of growth, they could come up with the $112,000 and get their 1.25 mil home. And suddenly, first-time home buyers' buying power are greatly inflated. So this is why I think if all these are implemented and interest rates stay this low, then we might see a very hot market for all homes up to the 1.25 mil in the next 2 years. And why I think it's not healthy, because it doesn't really solve problem for long term. It will just inflate the starter home price further, and for people that are later coming on trying to get their first home, it will be even harder for them to enter the market. Now, however, that doesn't mean I think all policy is bad. I think some of these actually is pretty interesting, especially the first-time home buyers, the 40K account that people can utilize. I just think that not all of these should be implemented, or maybe some sort of cap should be in place for some of these policies. For example, you could implement the 40K saving account, but only limit them up to maybe a 1 mil home or maybe even less. So you're more incentivizing first-time home owners to get a smaller unit just to become a homeowner sooner. But instead, if you combine everything, especially with a cap increase, now all homes up to 1.25 mil is going to be a lot more affordable, but in an artificial way. So we might see a bidding war happening again for that portion of the market. So that's something that we'll have to keep in mind to see how they're really implementing it and how that might play out. I hope it doesn't lead to a bidding war all over again. That's really not healthy. And I have heard so many stories of people buying a property and now totally regretting it because they were in the moment and they have way overbid outside of their comfort zone. However, if you think otherwise or you agree, you have other thoughts, let me know in the comment down below. I really want to hear your thought on all these. Now next, let's move on and talk about the Evergrande situation. So first, I want to give a very quick history lesson on what is basically happening with this company, why it is collapsing, and then we'll talk about what's the potential implication moving forward. Now Evergrande is basically the largest real estate developer in China by sales figure. And as we all know, China had a huge GDP boom for the last 2 decades. That means a lot of buildings are being built, and Evergrande along with other real estate companies have benefited a lot from this boom. Now what Evergrande does is basically they borrow to build at low cost, aiming at the mass market. They will sell the pre-sale, accumulate cash, and then use that cash to leverage to borrow even more and repeat the cycle again. And because of this boom and how aggressive they are borrowing, they have expanded at a tremendous speed, and they venture into other industries, for example food, insurance, etc. Recently, they have expanded into electronic vehicle, raising 3.35 billion USD in January. However, up to today, they have yet to produce a single car. Now, the problem with this is that real estate is one of the most heavily regulated market in China. In 2017, the government actually published an edict saying that homes are for living, not for speculating. So in 2020 August, they have implemented something called the 3 red line. Basically, you can see on the screen, it's 3 ratios that real estate company has to keep track and stay within if they still want to operate in China. Now, this is in place because the government wants to put a cap on the developer's max leverage until 2023. This obviously puts a lot of real estate companies under tremendous pressure because they usually are leveraged quite a bit. And it's true especially for Evergrande, who is leveraged up to their eyeballs by this time. So now they're in a cash crunch, and in order to meet these deadlines, they have to sell the existing condo inventories at a discount just to push sales so they can accumulate cash faster. On average, it's been reported that their discount is about 14%. And in June, Chinese banks are ordered to stress test their balance sheet for exposure to Evergrande. Now, the first sign of trouble is in July, when Evergrande skipped out on a special dividend that they promised to pay 2 weeks ago. Then one of their biggest partner, Chinese Estates, which is owned by one of the real estate tycoon in Hong Kong, starts dumping the Evergrande stocks in July and August. And this basically sends the stock in a spiral downward. And fast forward to September, this is where we are. With the future and potential for bankruptcy, a question that many investors and pre-sale purchasers are wondering. Now, Evergrande's debt is up to $300 billion in USD. Now, September 8th, they have announced that there will be no interest payment on all debt. And then September 13th, they announced that there's no bankruptcy coming up, but they're under tremendous pressure. This also impacted all markets globally, as about 20 billion of these loans are foreign debts. Now, shortly after, the Chinese government have announced that they will be taking over this company, separating them into 3 different departments, and finishing building any pre-sale that have not been built yet. And then after that, the market have rallied on this news. Evergrande shares also have go back up. Now, on this topic, I've seen a lot of people online saying that this is gonna lead to a global real estate crash and market crash, just like the Lehman Brothers, and then Canadians' housing price is going to tank, because either we're affected directly by this news, or Chinese investors have to massively sell their real estate holdings in Canada. I just want to make a quick comment about this. This company obviously is huge. It has a lot of connections, a lot of potential ripple effect that could happen and affect everyone across the globe. So we're likely going to see these kind of up and down volatility over, I would say, the next 2, 3, or maybe even 6 months down the road, because there are so many layers to this event that it's gonna take a long time to play out. So as of this moment, the right answer is that no one can tell you what's gonna happen. Now, my personal thought is that it's probably not gonna be something like the Lehman Brothers in 2008. And the reason why is because unlike Lehman Brothers, which is a financial bank with no real asset, Evergrande actually have a lot of real asset, and probably the most valuable ones, which are lands. And because of this, they can offload their land, negotiate, and be in much better position than what we have seen compared to the Lehman Brothers. So I don't think this is going to lead to a global market crash of 40% plus like we saw in 2008, but it might trigger some sort of correction, because as we have said before, P ratios are many folds than the average should be. People are very nervous. So this news could trigger a correction in global market, but the probability of a major crash is going to be less. Now, second of all, will it lead to a huge real estate crash in Canada? I also think not likely, Because like we said before, HELOC rate is so cheap. If any of the Asia homeowners really run into financial trouble because of Evergrande, then if they have HELOC, they can still use that to tie them over. We might see some people have a distressed sale here and there, but overall, I don't see a huge crash coming just because of Evergrande. More likely, if we ever were to see a correction in the real estate market, it will have something to do with local policy, like the ones we talked about, which push people to borrow even more than before. And when we're way over leverage, that's more likely to cause a correction when the interest rate increase, but not because of a real estate company collapsing, no matter how large, in another country. So that's today's video. Now, if you like everything I've been discussing, hit the like button once. If you don't like them, hit the dislike button twice. What I want to hear from you next is what you think about these two events, and do you agree that some is going to affect us more than the others? If you do, if you don't, let me know in the comment down below. If you like my videos, I do upload them 8:30 EST every Tuesday, so make sure you like and subscribe to the channel. Click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!